Good morning, my name is Andreea Elena Butnaru, and this presentation forms is part of my assessment 1 for the financial reporting module. We're going to talk and I will going to try to explain and to apply several key international financial reporting standards that play a fundamental role in preparing and presenting financial statements. I will begin with the IASB Conceptual Framework, followed by detailed discussion of 5 major standards. And we're going to see AIS 36, IFRS 5, AIS 21, IFRS 15, and IFRS 16. For each standard, I will explain what's the purpose, outline the key principles, and provide a real-world company example to demonstrate how the standards are being applied in practice. The aim of this presentation is to show a clear understanding of how financial reporting rules influence the measurements, recognizing, and disclosure of information in corporate financial statements, presentations, artifact. In the beginning, I would like to introduce the IASB framework and explain why it is such an important foundation for global financial reporting. IASB created the conceptual framework to guide how financial statements should be prepared and presented, as defined as the core building blocks of accounting, such as assets, liabilities, equity, incomes, and expenses. These concepts provide consistency across companies and across countries, which is very essential for users like investors, regulators, and auditors. Framework also explains what useful financial information should look like. It highlights characteristics such as relevance, faithful representations, comparability, verifiability, timeless, and understandability. Overall, IASB framework supports transparency and confidence in financial reporting. By setting clear principles, it ensures that the companies apply accounting standards consistently and that users can rely on the information presented. This helps create trust in financial markets and support better decisions making. Forward, we will walk through IASC 36, which deals with impairment of assets. The purpose of the standard is to ensure that assets are not carried at more than their recoverable amount. The recoverable amount is the higher of an asset's fair value less cost to sell and its value in use. If the carrying amount is higher than the recoverable amount, the company must recognize an impairment loss. To make this clearer, let me use a practical example. Let's talk about Apple. At some point, Apple decided to test one of its manufacturing machines for impairment. The carrying amount was £1 million. When Apple calculated the value in use, the discounted cash flow were £820,000. The fair value less cost to sell was £780,000. So the recoverable amount was £820,000. Because the carrying amount was above, the Apple recognized an impairment loss of $180,000. This loss was recorded in the income statements, and the asset value was reduced. Initially, assets are measured at the cost, primarily cost, the first one, but over the time, IASC 36 it ensures that impairment is recognized when it's needed. The recognition happens when the asset is sold or no longer provides economic benefits. Let's go overall and to talk about IFRS 5, which is applies when a company plans to sell an asset business or a component, and the sale is expected to happen within 12 months. Once an asset is classified as held for sale, it must be available for immediately sales and actively marked by management. The measurement also changes. The asset is measured as the lower of its carrying amount or its fair value less cost to sell. Depreciation stops from the moment the asset is classified as held for sale. For example, In UK at some point, BP plc decided to sell one of them refiners. Management approved a formal plan and the asset was marked for the sale. The carrying amount was higher than the fair value less cost to sell, so BP reduced the asset's value and presented separately in the financial statements under the status of assets held for sale. Any related income or expenses were shown under discontinued operations. Recognition occurs when the classification's criteria are met. Derecognition takes place when the asset is sold or when the criteria are no longer satisfied. So if we did understand how IFRS 5 is being applied, let's talk about AIS 21, which deals with the company's reports, transactions, and balances that are in foreign currency. The first step is to determine the functional currency of each entity, which is usually the currency of the primary economic environment in which is operating the business. Foreign transactions are recorded using the exchange rate at the date of the transactions. At each reporting date, monetary items such as receivables and payables are retranslated at the closing date. Any exchange difference are recognized either in profit or losses or in another comprehensive incomes. A good example comes from Shell plc. Shell has subsidiaries operating in USD, Euro, and GP. Obviously, Shell prepares consolidated statements, is translated the financial statements of dollars subsidiaries into GP, pounds. In the example shown in my chart, the USD percent pounds rate moved from 0.78 to 0.82 over 6 months, causing translation differences. These were recognized in another comprehensive incomes. This example highlights how currency movements directly affected reported financial results. Another principle it is IFRS 15, which provides a single 5-step model for recognizing revenue. The steps are: identify the contract, identify the performance obligation, determine the transaction's price, allocate the price to the obligations, and recognize revenue when controls transferred to the customers. Let's go ahead looking at Tesco, which provides a very clear example. When a customer orders grocery online for £120 and pays in advance, Tesco can't recognize revenue immediately. Have to identify one performance obligation, delivering the groceries. Even though Tesco has received payment, IFRS 15 requires revenue to be recognized only when control transfers to the customers, that is, when the groceries are delivered. Until then, the advance payment is recorded as a contract liability. This example highlights the shift from recognizing revenue when risk and rewards transfer to recognizing when it is control transfers, which provides a more accurate reflection of economic reality. A last one, it is IFRS 16, the principle which introduces a single lease accounting model. Under IFRS 16, companies must recognize a right-of-use asset and lease liability on the balance sheet at the start of a lease. What's mean lease liability? It's measured at the present value of future lease payments, while the right-of-use asset is based on the liability plus any initial costs. Over a lease term, the asset is depreciated and the lease liability is reduced as payments are made. A strong example is British Airways. British Airways leases a number of aircraft. Under IFRS 16 principle, recognized a right-of-use assets of 950 million and lease liability of 1,000 million. At commencement, this ensures that BA financial obligations are clearly presented on the balance sheet. The recognition takes place when the lease ends or the asset is returned. This standard improves Transparency by ensuring that material lease obligations are not kept off balance sheet. As a reference for all this presentation, I used management and cost accounting, Gingage. I used financial accounting and reporting, Pearson's, Elliott B. Elliott. IFRS Foundation 2024 Conceptual Framework, IFRS Standards, and Manual of Accounting IFRS 2024, Insights of IFRS, AGABB 2024 London Deloitte. Thank you so much, and I really hope you all did understand what's the principle and how we're looking at one financial reporting.